The stock market is currently showing a clear disconnect from the real economy, with record highs continuing despite rising economic uncertainty, inflation pressure, and financial stress in everyday life. In this breakdown, I, Dave Rubin, will walk you through the key signals investors are watching right now, from potential melt-up conditions and extreme valuations to historical bubble patterns seen in 1929, Japan, 1989, and the dot-com crash. We'll also explore why high market concentration and emotional investing behavior are raising concerns, and what smart investors should actually do in uncertain times. The statement, "The market shows a clear disconnect where stocks are hitting record highs despite economic uncertainty and real-world financial pressure," means that there is a growing gap between what the stock market is doing and what is actually happening in the real economy. In simple terms, the stock market is reaching new all-time highs, meaning investors are willing to pay more and more for shares of companies. This usually happens when people are confident about future profits, economic growth, and overall stability. However, at the same time, the real economy is showing signs of pressure, things like rising living costs, inflation, higher interest rates, geopolitical tensions, and financial stress on everyday households. This creates a situation where the paper economy, stock market, and the real economy are not moving in the same direction. Normally, stock markets and economic conditions tend to align over the long term. When the economy is strong, corporate earnings rise, unemployment is low, and consumer spending increases, which naturally pushes stock prices higher. But when there is uncertainty, like expensive borrowing costs or global instability, markets usually slow down or correct. In this case, however, the market continues to rise even though many underlying indicators suggest caution. This is what analysts refer to as a disconnect. One reason for this disconnect is expectations about the future. Investors are not just reacting to current conditions, they are pricing in what they believe will happen later. In this script's context, there is strong optimism around technology and AI-driven companies, which are expected to generate massive profits in the future. This expectation can push prices higher even if today's economy feels unstable. Another factor is market concentration. A small group of large companies, often referred to as mega-cap stocks, are responsible for a big portion of the market's gains. Even if many sectors of the economy are struggling, these large companies can still perform well enough to lift the entire index to new highs. This creates an illusion that everything is booming, even when that is not fully true across the board. However, this disconnect is also what makes investors nervous. When asset prices rise faster than real economic strength, it can resemble past bubble environments where optimism eventually became too extreme. That is why the script emphasizes both opportunity and risk at the same time. The market can keep rising, but it can also be vulnerable if expectations suddenly change. If you want to understand how this disconnect could impact your investments and learn how to protect yourself from potential market volatility, make sure to stay informed, subscribe for more breakdowns like this, and follow for deeper market insights that simplify complex financial trends. Experts use the term melt-up to describe a very specific and often dangerous phase in the stock market cycle where prices rise rapidly, not because of improving fundamentals alone, but because of accelerating investor optimism, fear of missing out, FOMO, and momentum-driven buying. In this stage, the market doesn't just go up steadily. It starts to climb faster and faster in a way that feels almost disconnected from normal economic logic. In a typical healthy bull market, prices rise gradually as companies grow their earnings, the economy expands, and investor confidence improves at a balanced pace. However, in a melt-up phase, that balance starts to break. Instead of investors carefully evaluating risk versus reward, more and more participants begin to buy simply because prices are rising. This creates a self-reinforcing cycle. Rising prices attract more buyers, and more buyers push prices even higher. The result is a sharp acceleration in the market's upward movement. What makes this phase particularly important is that risk does not disappear. It actually increases significantly, even though it feels like everything is going well. Many investors interpret rising prices as proof that conditions are safe, but in reality, this is often when valuations become stretched. Stocks can start trading far above their intrinsic value, meaning the price people are paying is no longer strongly supported by actual company earnings or economic output. Another key feature of a melt-up is emotional behavior dominating rational decision-making. Investors begin to fear missing out on further gains more than they fear losing money. This psychological shift can push even cautious investors to enter the market late in the cycle, adding more fuel to the rally. At the same time, risk management often weakens because losses are rare during strong upward moves, making people underestimate how quickly conditions can reverse. Historically, melt-up phases have often occurred near the late stages of major bull markets. They can last longer than expected, which is why they are so tricky. Prices can continue rising even when warning signs are present. However, they are usually followed by sharp corrections or bear markets once sentiment shifts or a trigger event breaks investor confidence. It is important to understand that a melt-up does not guarantee an immediate crash. Instead, it signals that the market is entering a more fragile and sensitive state. Gains can continue in the short term, but volatility and risk increase significantly beneath the surface. In simple terms, a melt-up is when the market stops behaving like a stable reflection of economic reality and starts behaving like an emotional acceleration engine, where optimism pushes prices higher at an unsustainable pace while the underlying risk quietly builds up in the background. This statement means that current stock market prices are very high compared to the actual earnings of companies, and the structure of the market is becoming unusually dependent on a small number of large companies, conditions that have historically been seen during past financial bubbles. To understand this, we first need to break down what valuations and P/E ratios mean. Valuation is basically how expensive or cheap a stock is considered. One of the most common ways to measure this is the price-to-earnings P/E ratio. It compares a company's stock price to how much profit it makes. If the P/E ratio is high, it means investors are paying a lot of money for each dollar of earnings. If it is low, it means the stock is relatively cheaper compared to its profits. When experts say valuations are historically expensive, they mean that today's P/E ratios are much higher than long-term averages. In simple terms, investors are willing to pay more for less earnings compared to what was normal in the past. This usually happens when investors expect strong future growth, but it can also signal that prices may have moved ahead of reality. Another important factor mentioned is market concentration. This refers to how much of the stock market's total value is controlled by a small number of companies. In this script, the top companies, often big technology or AI-related firms, make up a very large portion of the entire market index. That means the overall market performance is heavily dependent on just a few stocks. If those few companies perform well, the entire market looks strong. But if they struggle, the whole market can be affected. This combination of high valuations and strong concentration is what creates concern. In past bubbles, like the dot-com bubble in 2000, a small group of technology stocks also dominated market performance, and valuations reached extreme levels before eventually crashing. Similarly, during other historical bubbles, investors ignored traditional valuation metrics because optimism and hype took over. However, it is also important to note that high valuations alone do not guarantee a crash. Sometimes markets remain expensive for long periods if companies continue to grow their earnings and justify those prices. The real risk comes when expectations become too unrealistic, meaning investors assume growth will continue forever without any slowdown. In simple terms, this statement is warning that the market today is priced very optimistically and is heavily dependent on a few major players. While this does not mean an immediate collapse is coming, It does mean that the market is in a sensitive zone where any disappointment in earnings or growth expectations could lead to sharp corrections. This statement is highlighting a key idea from financial history. Major market bubbles often look different on the surface, but they tend to follow a very similar emotional and behavioral pattern before they eventually collapse. The examples mentioned: 1929 Great Depression, Japan's 1989 asset bubble, and the dot-com crash of 2000 are all used because they show how investor psychology and market dynamics can repeat across different eras. In each of these cases, the early stage of the bubble began with a strong and believable growth story. In 1929, industrial expansion and rapid economic growth created confidence that the market could rise indefinitely. In Japan, during the 1980s, people believed the country's real estate and stock market would continue growing forever due to strong economic dominance. In the dot-com era, the belief was that the Internet would completely transform the economy, and therefore technology stocks justified extremely high valuations. As prices started rising, more investors entered the market, not always based on careful analysis, but because they saw others making money. This created a feedback loop where rising prices attracted more buyers, and more buyers pushed prices even higher. This stage is often driven by extreme optimism, where people start believing that this time is different, and traditional valuation rules no longer apply. Another common feature across all these bubbles is the gradual detachment from fundamentals. Stock prices or asset values rise much faster than actual earnings, productivity, or economic output. In Japan, real estate prices became so high that land in Tokyo was famously said to be worth more than entire countries. During the dot-com bubble, many companies with no profits reached massive valuations simply because they were associated with Internet growth. In 1929, margin debt and speculation pushed prices far beyond sustainable levels. Eventually, however, reality catches up. The trigger for the collapse is often not obvious at first. It could be rising interest rates, slowing growth, or loss of confidence. But the real cause is usually that expectations become too far removed from what companies or the economy can actually deliver. Once investors begin to question those expectations, sentiment shifts quickly. Instead of buying aggressively, people start selling, and the same feedback loop that drove prices up now pushes them sharply down. What makes these bubbles similar is not the exact cause, but the emotional cycle: excitement, belief in endless growth, widespread participation, and, finally, overconfidence. When optimism reaches its peak, even small negative signals can cause a major reversal. However, it is also important to understand that not every strong market rally ends in a crash. The lesson from history is not that markets will always collapse, but that when optimism becomes extreme and detached from reality, risk increases significantly. These examples are used as warnings to show how powerful investor psychology can be, and how it can override logic for long periods before eventually correcting. This statement is explaining a very important investing principle. In uncertain market conditions, the goal should not be to predict short-term movements or react emotionally, but instead to build a stable strategy that can survive ups and downs over time. When markets are volatile or unclear, meaning prices can rise or fall sharply without warning, many investors feel pressure to make quick decisions. Some try to time the market, meaning they attempt to sell before a crash and buy before a rise. Others panic and sell when prices drop, fearing further losses. However, history has shown that these emotional reactions often lead to worse outcomes than simply staying invested with a disciplined plan. Disciplined diversification means spreading your investments across different sectors, industries, and asset types instead of relying on one area of the market. The idea is simple. Not all investments move in the same direction at the same time. For example, if technology stocks fall but other sectors remain stable or grow, diversification helps reduce overall risk. This approach does not eliminate risk completely, but it helps smooth out volatility so that one bad segment does not destroy the entire portfolio. Long-term investing focuses on holding investments for years or even decades, rather than trying to profit from short-term price movements. The reason this strategy is often recommended is because markets tend to grow over long periods despite temporary crashes, recessions, or corrections. While short-term fluctuations can be unpredictable, long-term trends are generally driven by economic growth, innovation, and corporate earnings expansion. The key idea behind this statement is survival over prediction. Instead of trying to guess exactly when a crash or rally will happen, investors are encouraged to build a strategy that can withstand both. This reduces emotional stress and prevents common mistakes like panic selling at the bottom or buying at the peak due to hype. Volatility, although uncomfortable, is a normal part of financial markets. Prices move up and down because new information constantly affects investor expectations. A disciplined investor understands that these fluctuations are temporary and focuses instead on long-term financial goals. If you want to learn how to build a strong, diversified portfolio and understand how professional investors manage risk during uncertain markets, subscribe for more detailed breakdowns like this. Stay consistent, stay informed, and focus on long-term growth instead of short-term noise. This content is for educational and informational purposes only and should not be considered financial advice. Investing in financial markets involves risk, including the potential loss of capital. Always do your own research or consult with a qualified financial advisor before making any investment decisions.